On China to drive growth as Europe's recovery falters and the U.S. grapples with unemployment. But Chinese data in the last few hours has been described as really ugly by my next guest. He's Darius Kowalczyk, Chief Investment Officer at SJS Markets, and he joins me now live from Hong Kong. So Darius, this is manufacturing data we're talking about. It expanded by the least in a year in February. So what does it mean?
The data is indeed quite bad because it shows that sentiment among Chinese manufacturers has deteriorated rapidly and quite unexpectedly. In particular, we have a major slowdown in the growth rate of production and new orders, and outright declines in backlog of orders, inventories and employment. And this implies that fiscal stimulus is probably being withdrawn by Chinese policymakers at a pace that is reducing the sequential growth rate of the entire economy, which in turn implies that global growth is probably going to peak in the second quarter and slow further down the line.
But can't some of this weakness in these numbers be put down to the Lunar New Year holiday?
I think there could be some small impact of that, but when you look at the past 5 years, there was almost no influence of the Lunar New Year on PMI data. And that's why I think that most of the slowdown has to be explained by an actual deteriorating in sentiment and in future manufacturing activity.
You say this is likely the effects of the Chinese government's fiscal and monetary tightening, this gradual tightening that they've started. So how does this change the outlook for that tightening?
It seems that the impact of measures to slow growth is likely to come faster and be more pronounced than probably even policymakers themselves have been anticipating. And that means that we do not need as aggressive monetary tightening going forward as I had anticipated. So I think that we will see at most 3 more increases in the RRR rate and not more than 3 hikes in lending rates this year.
So Darius, how are investors taking this? Because presumably if China's economy isn't overheating, if the outlook for tightening isn't as aggressive, that should be a good thing, right?
It is a good thing in the sense that monetary policymakers will not need to slow global growth too aggressively. But at the same time, China has been a major driver of the growth, contributing the most among any nation last year to the pace of the global economy. So if China is slowing, then it's quite likely that other countries will slow as well. Already today, in Korea's exports data, we saw a major slowdown in overall exports, partially due to the fact that they have been exporting not as aggressively to China. So definitely, probably a few months down the line, this will have a big impact on equities and commodities worldwide.
Are we going to see a global double dip?
I'm a big believer in the double dip. I think that it will occur because G3 economies are running right now almost only on government spending, and private sector demand will not be strong enough to pick up the baton when these fiscal stimulus packages run their course. So Q4 this year, Q1 next year, I think there will be another recession in the US, Japan and the Eurozone.
Darius Kowalczyk there for us. Thanks so much. From